Hey everybody, and welcome to the Deep Beat Explainer Financial Education Series. Today we're diving into a really fascinating puzzle. When the world's most famous investor is sitting on a mountain of cash, where in the world does he actually put it? The answer is pretty surprising, and it reveals a pro-level strategy that you know what? You can use it yourself. Let's get right into it. So first, let this number sink in for a second. As of May 2025, Warren Buffett's investment vehicle, Berkshire Hathaway, had a record $347.7 billion in cash and equivalents, roughly 30% of its total assets on hand to weather a potential market crash or big correction. The underlying question is, how can the world's most successful investor maintain such a vast cash reserve while remaining ready to strike when the proper moment arises? It is whole wide world know which stock Mr. Buffett invested, but only few knows where he keep his money before he make an investment. When sophisticated investors store cash, they are not simply keeping it idle. They thoroughly comprehend the time worth of money and the potential cost of allowing cash to stay idle. That is why, rather than keeping plain cash, they invest it in cash equivalent financial securities. In this episode, we'll look at the three main options for cash storage: US Treasury notes, government money market funds, and high-yield money market accounts. We'll also look at where Warren Buffett places Berkshire Hathaway's vast cash reserves and identify the best options for average investors. To make this more practical and understandable, we'll examine how a hypothetical $1 million investment over a 6-year period from 2019 to 2024 would have performed in each of these three scenarios. We're about to pull back the curtain on exactly what those tools are, and in the process, learn the rules to a financial game that most people don't even know is being played. To figure this out, we're going to stage what we're calling the ultimate cash showdown. We are pitting the three main options for parking huge amounts of cash against each other. Now, you might think they're all kind of the same, but as we're about to find out, each one comes with its own unique superpower. First up in the ring are US Treasury Bills, or as they're known, T-bills. You can think of these as the absolute gold standard of safety. They're basically short-term IOUs straight from the US government. But their real superpower, the thing that most people overlook, is their tax status. The interest you earn is totally exempt from state and local taxes. Remember that it's going to be super important in a few minutes. The second contestant is government money market funds, or MMFs. These are basically big pools of money professionally managed that invest in super safe government debt. Their superpower? They're incredibly easy to get your money in and out of. Total liquidity, and they offer really competitive rates. The catch? They're not FDIC insured, and you're going to pay taxes on all the earning. In our final contestant in the showdown, high-yield money market accounts. These are a special kind of bank account, and their superpower is just rock-solid security. They're FDIC insured up to $250,000 per person per bank. The downside is pretty clear though. Every single penny you earn in interest is fully taxed. All right, the stage is set. The contestants are ready for round one. We took a hypothetical $1 million and ran it through each of these three options over a 6-year period from 2019 to 2024 based on the research we conducted. Now it's time for the big reveal. After the years, here's how our $1 million investment did in each scenario. In third place, high-yield money market accounts in banks earned $139,942 in total interest over time. In second place, the government T-bill strategy gained $151,699, or approximately $11,800 more than the money market account. In nominal terms, the winner was government money market funds, especially Vanguard's VMFXX, which generated $153,605 in total returns. That is over $13,700 more than the high-yield money market account. Let's look at how Warren Buffett's $347.7 billion cash reserve could increase over same years, depending on where he keeps it. If he invested it in a high-yield money market account, which is a bank product, it would increase to almost $396 billion. If he chose U.S. Treasury Bills, a government financial instrument, the amount would be around $400 billion. And if he invested in a government money market fund, which is an investment fund product, it may increase marginally to around $401 billion. It was a really tight race for the top spot, with T-bills coming in second. But our winner, just by looking at the pure numbers, is the government money market fund. Or so it seems, so game over, right? The money market fund made the most money, so it must be the obvious choice for someone like Buffett. Well, not so fast. The story is definitely not over. There's a hidden factor here, a piece of the puzzle that changes the entire outcome. And it's the secret that really separates the amateur investors from the pros. And here it is, the deciding factor, the one thing that flips this entire competition completely on its head. Taxes. You see, pro investors know it's not about what you make, it is all about what you keep. We've got to look at the after-tax reality. I absolutely love this analogy. Comparing these investments without thinking about taxes is like shopping for two cars, but one of them comes with free gas for life. You can't just look at the sticker price, right? You have to factor in the incredible value of that free gas to see which one is the actual better deal. We just need a tool that lets us do that, and that tool has a name. It's called the Tax Equivalent Yield, or TEY for short. Now, this is how the pros leveled the playing field. It's a simple but absolutely brilliant concept that just answers one key question. To get the same amount of money in my pocket from this tax-advantaged investment, how high would the interest rate on a fully taxable one have to be? This little formula reveals the true power of each option. Okay, now let's look at the showdown again, but this time with our new pro tool, the column on the left, nominal yield. That's what we saw before. The money market fund looks like the winner with its 5.23% yield. But now, look all the way to the right at the tax equivalent yield. All of a sudden, the TBI is the undisputed champion. It's not even close. To get the same after-tax result from a regular taxable account, you'd need that account to pay an insane 7.89%. And that is the answer to our mystery for Warren Buffett. Managing cash isn't just about chasing the highest possible rate. It's about two things, protecting the money and being smart about taxes. So what does this all mean for you? Well, the great news is you don't need to be a billionaire to start thinking like a pro. For the average investor with, say, $1 million set aside for short-term use, betting on a single option is not the best strategy. The professional technique involves combining all three tools, T-bills, money market funds, and high-yield savings in a tiered cash management system that balances safety, liquidity, and return. You can use this exact same logic for your own cash, whether that's your emergency fund or money you're saving for a house. Let's talk about how to build your own financial fortress. A pro-level strategy has tiers. So tier 1 is your foundation, your emergency foundation. Contribute $250,000 to a high-yield money market account. Why exactly this amount? It represents the maximum FDIC insurance coverage per account at each bank. This is your emergency fund, which is instantly available and guaranteed by the government to be safe. If you require additional FDIC coverage, simply create accounts with multiple banks. Tier 2, your core holdings. Invest the remaining $750,000 in a government money market fund or a laddered T-bill approach. If you live in a high-tax state, T-bills are a great option for tax savings. If you value simplicity and don't mind paying state taxes, consider a low-cost government money market fund. So as we wrap all this up, what's the one single biggest lesson we can take from all this? It's this: smart investing is not about chasing the highest number on the screen. It's about understanding the real rules of the game. things like taxes. Then use those rules to your advantage. True financial success isn't about winning one column in a spreadsheet. It's about seeing the entire picture. These professional strategies are not some secret locked away in a vault in Omaha. They're accessible to anyone who takes a little time to understand them. So that really just leads one final question. Now that you know the secret, how are you going to build your financial fortress? Remember that cash management is more than just safety. It's also about optimizing every dollar for your individual needs. Whether you manage $1 million or $1 billion, these principles apply to help you maximize your after-tax, after-inflation returns while retaining the liquidity and safety you require. Thanks for your time with us. If you want to explore more, we get plenty of financial and investing video in our channel.